Welcome to our today's video, and in this one we are comparing two investment vehicles. We are assuming an investment of 500,000 in each of the two vehicles. Our first one is a money market fund that compounds on a daily basis and is paying us an annualized return of 18% gross. The second vehicle shall be an infrastructure bond that has a coupon rate of 18%. The purpose of this comparison, we want to evaluate the two investment vehicles and ultimately determine which of these two vehicles shall yield the higher return to the investor. The reason for this evaluation is that, number one, many of our investors get blindfolded by the wording of daily compounding in money market funds, and that gives them an absolute thought that a money market fund is destined to give you higher returns compared to other vehicles without using a pen and paper. The second reason why this is important is that we want to evaluate and distinctly show the importance of doing the math and establishing the right vehicle to put your investment. For the purpose of this comparison and to be fair to the two vehicles, we shall ensure that all facts relating to the two investment vehicles are brought to play, and to be precise, number one is the question of taxation. Adjusting the money market fund gross return of 18%, money market funds are taxed at a withholding rate of 15%. That amounts to a 2.7%, and once you deduct that one from the gross 18%, we shall be left with a net return from the money market fund of 15.3%. On the other hand, infrastructure bonds are issued free of taxes, and therefore this 18% remains the net return to the investor. You'll notice that mainly what bedevils the choice of a money market fund against the infrastructure bond is the thought and the fact that the coupons that are paid back to the investor as a return on investment in the infrastructure bond are not automatically reinvested, but they are relayed back to the settlement account of the investor, which is dislinked from the investment account. And if you compare that one to a money market fund, the money market fund, the investment account is the same account where the returns are paid, and therefore it makes the whole amount, that is the principal, the original amount invested, and the returns available to the fund manager for reinvestment, and therefore that brings in automatic compounding. On the other hand, when you look at the infrastructure bond, the investor also has a leeway of flagging their CSD account, and what that one does is that it enables the issuer of the bond, that is Central Bank of Kenya, to automatically reinvest any amounts that are maturing or coupons that are being paid out from the bond. And that one would also amount to the investor topping up any amount that will be required to meet the minimum amount for investment. And therefore, for this one, we are assuming that everything that can be done actively by the investor in the infrastructure bond to ensure compounding of that investment is allowed, so that we be fair to the two investments. It's either through flagging of the account or actively reinvesting the coupons once they are relayed to the settlement account, either to another equally yielding investment, or better still, we shall wire those coupons into the money market fund that originally invested the first option. If you have not watched the video on flagging your CSD account or automating the reinvestment of your coupons and maturities from your CSD account, then we have this video that we are attaching in the description that you can watch and flag your account if need be. The other thing that will be important for this evaluation is the fact that we will not allow any withdrawal for the period of investment which has been set to be 10 years. We shall also adopt the fact of portability of money market funds, and that means that because we are pegging our investment return at a minimum of 15.3%, in the event that money market fund goes below that return, it will be free to move our investment to another money market fund that equally compounds on a daily basis and gives us our target return of 15.3% in order to maintain the two vehicles under evaluation at par. We shall be looking at the calculations after 3 seconds break. And as usual, if you are new to this channel, we request you bless us with your subscription and don't fail to hit the notification button, because this channel dedicates at least 4 videos per week and YouTube will be giving you a notification when we upload one. Our subscribers, we always appreciate you. See you after 3 seconds break, after you have given a like and you have given us your comment, your opinion in the comment section. Welcome back, and thank you for that comment, that subscription, that like and a share. I'm armed with my 10 shillings pen as usual, my extra mobile phone and a calculator for those complex calculations. And to begin with, we are looking at the investment of 500,000 in a daily compounding money market fund at an annualized return of 18% for 10 years. The first step will be to adjust that gross return of 18% to a net return for our calculation. Money market funds are taxed at a withholding rate of 15%. If you subject 15% to the gross tax of 18%, that gives you a tax amount of 2.7%, and that leaves us with a net of 15.3%. That is what we indicated on the thumbnail. Then the second step now is to determine the total amount that we'll have built in our money market fund in a period or in an investment period of 10 years. Let's get down to the calculation. So our usual compounding formula is amount is given or will be equal to our principal of 500,000. In brackets, we shall have a factor of 1 plus a rate to the power of the number of times that interest shall be calculated and compounded. That is where the first question is. We have to determine the daily rate. And the daily rate will be given as the annualized rate of 15.3% divided by the number of days in a year. And that is 365 days. So quickly, when you divide 15.3% divided by 365 days, you are getting a 0.041917808219178, and this is the figure, or this is the value. That value, we need not round off the figure to either 2, 3, or 4 decimal places, because the rounding off will build a round off error that will give us a huge disparity when we are comparing our manually calculated value or total with what we shall get as the amount as per a money market fund calculator. It's very important we compare our manually calculated result and the result of a money market fund calculator, because that builds, or it's a checker, that is a control to ensure that we are correct in our calculations, and it also now narrows down on our next calculations so that we avoid the complex manual calculation and now narrow down to what the money market fund calculators will be giving us. Once we have established the daily rate, which we have gotten already as 0.0419178, we are supposed now to determine, not that this is a rate, and a rate is a percentage or it's a figure that is out of 100. So the actual value for our question, in the bracket we have a factor of 1 plus the rate. So this one is the same as saying 1 plus 0.00419178. I truncate at 6 decimal places to reduce my round off error. So once we have done that, the power of n represents the number of times that interest shall be calculated for compounding purpose. And in this case, we are compounding on a daily basis for a period of 10 years. Each year is giving us 365 days. So in total of 10 years, we are talking of 3,650 days. On calculation, I'm getting the value of 2,308,348. That is the value that I'm getting. If there's a distinction between what I've gotten and what the money market fund calculator will have given, is the result of the round of error, because I did not use the full value of the daily rate. So that being the result, or the total amount that will be in that account, remember our initial principal investment of 500,000, and this is the result that we have gotten after investing for a long 10 years. And that means that we are getting interest in neighborhood of 1.8 million. That is collaborated or confirmed by these results that we have gotten from the money market fund calculator. And that means that our calculations were correct. The second option, that is investing our 500,000 in an infrastructure bond that is giving us coupons at 18%. For this computation, for an infrastructure bond, we have to bring in the fact that infrastructure bonds investments are not held to term. Infrastructure bonds redemptions are in options. And all investments in infrastructure bonds of an amount that is less than $1 million, they normally get a maximum investment period of 3 years. Some may be redeemed after 1 year, 2 years, but a maximum of 3 years in most cases. And that is what we are going to assume for this calculation, because we must be factual and fair, because that is the facts as they are with the investment. And therefore, when we invest our 500,000 in the infrastructure bonds, infrastructure bonds pay coupons biannually, or after every 6 months, you get a 50% of the total year coupon. That should send an assumption. The 18% is the future value, but you are getting your money earlier. The 50% comes earlier. That should also speak towards the total incomes or the total return out of the investment after the exhaustion of the investment term. But as we shall look from the calculations, you will notice that because I decided to use the ethical money market fund calculator, and this calculator does not allow us to calculate for any period that is less than a year. And we purpose as a channel, WealthSense channel shall do an email to Ethica recommending an adjustment of their computations to be in days and not years, so that we accommodate any calculation for an investment that is less than 1 year. So that said, our coupons from our infrastructure bond In the first 3 years where we shall be investing before the redemption, full redemption happen, whatever we shall be receiving mid-year, we will not calculate, but we will consider the calculation at the end to see whether we can adjust the results. But we shall assume we are receiving our coupons in full at the end of the year to bypass that challenge with the ethical money market fund calculator. So the first year we are going to receive our coupon of 90,000, and because we have not flagged our $1,000 account, this coupon is related to our settlement account, and we choose to take that coupon and invest in the same money market fund in option 1. And using the same formula for compounding, because this coupon has come after the expiry of the first year, when we reinvest that coupon of 90,000 in our maximum investment period of 10 years, it means we shall be investing for 9 years. So compounding that amount, I want us to use block investments to make this calculation simpler. So we are taking the 90,000 we are getting as coupon in the first year and invest it in the money market fund for the remaining 9 years. And as per the calculation, and is collaborated by the ethical money market fund calculator, we are getting a total of 356,566. In the second year, we are receiving another 90,000 because we are still within the investment period in the bond term. So the second 90,000 we are investing for the remaining 8 years in the same money market fund, and that investment is collaborated or determined by through the ethical money market fund shall give us a total of 305,998. Then in the third year, as we had indicated, a full redemption will happen because as an option we have said infrastructure bonds, any amounts invested that are less than $1 million are redeemed in a maximum of 3 years. So we shall now receive our 590,000. The 500,000 which was the principal investment amount and the 90,000 coupon. So that 590,000 we shall invest in the same money market fund in option 1, and we are investing for the remaining 7 years. Once we have done that investment, we shall get a total figure or a total value of 1,721,408, and this is the result of the money market fund calculator. So we have 3 values, or we have 3 figures. We have the 3 blocks. The first coupon reinvested, the second coupon reinvested, and a reinvestment of the amount, the total redeemed amount. What does that one give us? On addition of the 3 values, I'm getting a value of 2,383,964. Having been an active investor, a DIY in the infrastructure bond for those 3 years, then now moving the redeemed totals into the money market fund that is in option 1 for the remaining 7 years to term, the investment in infrastructure bond will have yielded 2,383,964, while our investment in the money market fund will have yielded 2,308,348. Those 2 values compared, the infrastructure bond has yielded much more than the money market fund, with a difference amounting to 75,000. But remember, as earlier confirmed, the money market fund calculator does not give us room to compound for days. we would have taken the 45,000 in the 3 years of investing in the infrastructure bond, which are giving us a 45,000 mid-year coupon, and reinvest it. But because of the challenge of the money market fund calculator that does not recognize a 0.5 years or any period below a year, then we could not compound that one. But manually calculating that value, it would be giving us a figure of a total of 25,000 in addition to the difference that we are getting from those two investments, meaning that the investment in the infrastructure bond will have yielded more by over 100,000 shillings. So that means the option of infrastructure bond takes the day is the option that gives us a higher return compared to the money market fund. It's also important we recognize the fact that bonds are financial assets which are recognized as acceptable collaterals if the investor wanted any other capital in form of a borrowing, while that is not available when it comes to money market funds. That is our conclusion, and the investment in infrastructure bond takes the day. Thank you for watching.